Welcome to Chapter 8, Portfolio Management of Money Market Funds. Money market funds are designed to feel quiet, stable value, ready liquidity, and a yield that follows the short-term market. But that calm experience is manufactured. Underneath it sit maturity limits, liquidity buffers, credit analysis, diversification rules, pricing methods, fee decisions, and daily operational controls. This chapter explains how those pieces work together under Rule 2-7. We will distinguish government, prime, tax-exempt, retail, and institutional funds, compare stable and floating NAVs, separate weighted average maturity from weighted average life, and study the stress events that reshaped the rule book in 2008 and 2020. The central idea is simple. A money market fund is an investment company, not an insured bank deposit. It can be highly conservative without being risk-free. Money market funds are sometimes described as boring. In finance, boring is usually a compliment earned through a surprising amount of work. Money market funds sit at the intersection of household savings, corporate cash management, short-term government finance, and institutional liquidity. In mid-July 2026, total money market fund assets were about $7.89 trillion. Government funds alone accounted for roughly $6.51 trillion. At that scale, a rule change that looks technical can affect markets, issuers, and millions of investors. And the updated framework generally requires at least 25% in daily liquid assets and 50% in weekly liquid assets. Those buffers matter because the fund promises ready redemption while holding a portfolio of securities, and one distinction must remain clear. Money market fund shares are not FDIC insured deposits. The user experience may resemble cash, but the legal structure and risk protections are different. Stability is engineered through short maturities, liquid assets, diversification, pricing controls, and investor segmentation. Cash usually does not arrive with a portfolio manager, a board, and several hundred pages of regulation. Money market funds do. This chapter develops 4 practical skills. First, classify. You should be able to distinguish government, prime, tax-exempt, retail, and institutional money market funds because the label changes both the portfolio and the shareholder experience. Second, measure. You should be able to interpret weighted average maturity, weighted average life, daily and weekly liquidity, shadow NAV, yield, and expense waivers. Third, explain. You should be able to describe how Rule 2-7 and the 2023 reforms address run risk, dilution, and liquidity pressure. Finally, evaluate. You should be able to compare a money market fund with a bank deposit, a direct treasury bill, a short-term bond fund, or a stable value option. Some of these tasks involve numbers, but the more difficult work is judgment. A slightly higher yield may come from lower fees, more credit exposure, longer maturity, or a temporary waiver. The goal is not to memorize every rule. It is to understand what problem each rule is trying to solve. 4 connected questions organize the chapter. First, what product are we actually discussing? Government, prime, tax-exempt, retail, institutional, stable NAV, and floating NAV are not interchangeable labels. Second, what portfolio limits support the product? That brings us to credit quality, diversification, individual maturity, weighted average maturity, weighted average life, and liquidity. Third, what mechanisms support price stability and fair treatment? We will examine amortized cost, penny rounding, market-based shadow prices, and liquidity fees. Fourth, what did stress reveal? The reserve primary fund in 2008, the dash for cash in March 2020, Federal Reserve support, and the 2023 reforms all changed how the industry thinks about first mover advantage. The sequence matters. Product design determines the risks. Portfolio limits shape the available Response. Pricing and fees affect investor incentives. Stress reveals where the architecture bends. The goal is a usable mental model, not a trophy case of acronyms. A money market fund and a bank deposit can both support cash management, but they are different legal and economic claims. In a money market fund, the investor owns shares of a registered investment company. The fund owns short-term market instruments, and the shareholder yield changes with portfolio income and expenses. Redemptions occur at the applicable NAV under the fund's rules. There is no FDIC insurance. With a bank deposit, the customer has a claim on the bank. The bank sets the account rate and manages loans and securities on its own balance sheet. Eligible deposits may receive FDIC insurance within applicable limits, while access depends on the account agreement and banking rules. Neither column automatically wins. The correct comparison includes yield, insurance, counterparty concentration, tax treatment, cutoff times, settlement, convenience, and the amount of cash involved. Calling both products cash does not make them identical. Calling a pickup truck and a sedan transportation does not make them the same tool either. Rule 2, a 7 creates the operating boundaries for a money market fund. It limits what the fund may own, how long the portfolio may extend, how concentrated it may become, how much liquidity it must maintain, and how its shares are valued. Eligible securities must satisfy the rule and the fund's own policy. Maturity controls operate at both the individual security and portfolio levels. Liquidity minimums are paired with ongoing stress management. Diversification limits reduce dependence on a single issuer or guarantor with provisions that vary by fund category. Valuation may use stable or floating NAV mechanics, but market-based shadow pricing still matters. The board and advisor oversee credit, liquidity, fees, stress testing, and material events. Think of the rule as guardrails, not a force field. Guardrails reduce the probability and severity of an accident. They do not repeal market risk, credit risk, liquidity risk, operational risk, or investor behavior. Regulation can narrow the road. It cannot stop every driver from panicking when traffic appears. Money market fund is a family name covering several materially different designs. Government funds invest almost entirely in cash, government securities, and fully collateralized repurchase agreements. Prime funds may add commercial paper, certificates of deposit, bank obligations, and other short-term credit instruments. Tax-exempt funds seek federally tax-exempt income primarily through municipal securities. Retail funds limit beneficial owners to natural persons and may use stable NAV treatment where permitted. Institutional funds serve organizations and other non-natural persons. Institutional prime and tax-exempt funds generally use floating NAVs. Treasury-only funds are a narrower form of government strategy and may be selected for particular collateral, credit, or tax preferences. The category affects yield, credit exposure, pricing, fees, and likely behavior under stress. A corporate treasury department and an individual emergency fund may both want liquidity, but they do not necessarily need the same vehicle. The phrase money market fund gets us into the building. It does not tell us which room we are in. Weighted average maturity, or WAM, and weighted average life, or WAL, control different risks. Both are portfolio weighted measures. The basic structure is the sum of each position weight multiplied by the applicable days to maturity, but the word applicable changes the result. WAM can recognize certain interest rate reset dates, so it focuses more directly on rate sensitivity and how quickly portfolio income can adjust. WAL generally looks to final legal maturity, so it better captures credit exposure, liquidity extension, and the possibility that principal remains outstanding longer than the next coupon reset. A floating rate instrument illustrates the difference. Its coupon may reset soon, producing a short WAM, while principal may not mature for much longer, producing a longer WAL. In calm markets, the next reset may feel important. In stress, final maturity can become the more uncomfortable date on the calendar. WAM tells us how quickly the rate can move. WAL reminds us how long the money may still be committed. Liquidity is not simply an asset that can be sold eventually. For a money market fund, the relevant question is, what can turn into cash quickly, predictably, and with limited loss? The 2023 reforms raised the general minimum daily liquid asset level to 25% and the weekly liquid asset level to 50%. They also changed the anti-dilution framework. Certain institutional prime and tax-exempt funds must apply a mandatory liquidity fee when daily net redemptions exceed the regulatory threshold. At the same time, the amended rule removed the earlier link between a liquidity threshold and temporary redemption gates. Why? Because a visible gate trigger can become a flashing exit sign. Investors may redeem before the threshold is reached, creating the very pressure the rule was meant to contain. The redesign tries to reduce first mover advantage by holding more liquid assets and allocating liquidity costs more directly to redeeming investors. A liquidity rule should absorb a run, not accidentally send the invitation. Stable NAV and floating NAV designs make portfolio value changes visible in different ways. Government and eligible retail money market funds commonly seek a constant transaction price, such as $1, using amortized costs and penny rounding methods permitted under Rule 2(7). But the fund still monitors a market-based shadow NAV. Stable does not mean the portfolio never changes in value. It means the transaction convention is designed to remain stable within the rule's boundaries. Institutional prime and institutional tax-exempt funds generally use floating NAVs calculated to more decimal places. Small changes in market value therefore appear directly in the transaction price. That transparency can make risk more visible, but it does not eliminate redemption pressure. Operational systems must also support fluctuating prices, accounting, and shareholder records. The key lesson is that price convention cannot substitute for maturity, liquidity, credit, and diversification discipline. A stable NAV is a pricing method, not a government-issued promise that nothing awkward will ever happen. Money market fund yield begins with the income earned on treasury bills, repurchase agreements, commercial paper, deposits, and other holdings. Shareholders receive the result after management, administration, transfer agency, distribution, and operating expenses. That makes fees especially important when short-term rates are low. During near zero rate periods, advisors often waived expenses to preserve a competitive or non-negative shareholder yield. Some waivers are temporary, and some contractual arrangements may permit later recoupment if conditions and disclosures allow. Yield also adjusts with a lag. A policy rate move does not instantly reprice every holding. The portfolio changes as securities mature and cash is reinvested. Tax-exempt yield requires another adjustment because the relevant comparison depends on the investor's marginal tax situation. So the highest quoted yield is not a complete answer. It may reflect lower expenses, more credit risk, longer maturity, a different tax profile, or a temporary waiver. Yield is the headline. The footnotes explain who picked up the tab. The money market fund rulebook has evolved through stress. In 2008, losses on Lehman Brothers commercial paper helped cause the reserve primary fund to break the dollar, followed by broad redemptions from prime funds. The 2010 reforms strengthened liquidity, maturity, quality, stress testing, and disclosure requirements. The 2014 through 2016 reforms introduced floating NAVs for institutional prime and tax-exempt funds and added fee and gate tools. Then March 2020 produced a different test. During the dash for cash, institutional prime funds faced heavy outflows, while markets for short-term credit were under pressure. The Federal Reserve's money market mutual fund liquidity facility helped restore market functioning. by supporting purchases of eligible assets. The 2023 and 2024 changes raised liquidity minimums, removed gates tied to liquidity thresholds, and adopted mandatory liquidity fees for specified funds. Each reform responded to a failure mode. The recurring lesson is that rules change not only portfolio mechanics, but investor incentives. Sometimes the threshold becomes the thing everyone watches. This chart shows the modern money market fund complex as of the ICI weekly release dated July 16th, 2026. Total assets were about $7.893 trillion. Government funds held approximately $6.511 trillion. Prime funds held about $1.236 trillion. And tax-exempt funds about $146 billion. The exact totals move every week, so the chart should not be treated like a permanent balance sheet. The structural point is the overwhelming weight of government portfolios. That dominance reflects several forces: post-crisis reforms, investor preference for perceived safety and liquidity, the depth of treasury and repo markets, and the migration of assets away from some prime products. It also means money market funds are deeply connected to short-term government finance. A large category can look conservative at the individual fund level while still becoming systemically important in aggregate. The chart tells us where the assets are. It does not by itself tell us which product is best for a particular investor. March 2020 exposed the first mover problem. During the most acute phase of the dash for cash, institutional prime money market funds experienced roughly $139 billion of outflows. Funds needed liquidity. At the same time, dealers and buyers were constrained. Selling commercial paper, certificates of deposit, and other short-term credit instruments could impose meaningful transaction costs or require price concessions. If redeeming shareholders can leave at a price that does not fully reflect those costs, the remaining shareholders absorb the dilution. That creates an incentive to redeem early, even for investors who still believe the portfolio is fundamentally sound. A threshold tied to fees or gates can make matters worse if investors monitor the threshold and rush to exit before it is reached. Redemptions then transmit stress from the fund to short-term issuers and funding markets. The Federal Reserve facility helped restore functioning, while later reforms emphasized higher liquidity and more direct cost allocation. When everyone wants the exit at once, even a product designed for calm discovers its cardio. A money market fund review should begin with the cash job. Is the money needed for payroll, in an emergency reserve, collateral, settlement, tax management, or modest yield enhancement? Next, identify the category: government, treasury only, prime, tax exempt, retail, or institutional. Then examine liquidity. What percentage is daily and weekly liquid? How concentrated is the shareholder base? What happens under stressed redemptions? Review maturity and credit through WAM, WAL, issuer mix, structure, and the fund's minimum credit standards. Examine price and fees, stable or floating, NAV, exposure to liquidity fees, the expense ratio, and any waivers. Finally, compare access and alternatives, the cutoff times, settlement minimums, wiring procedures, FDIC insured deposits, direct treasury bills, and short-term bond funds can all matter. Cash management is a hierarchy of needs: certainty, access, preservation, tax, and yield. The order matters. Reaching for an extra few basis points before defining the job is how cash quietly auditions for a riskier role. Consider a corporate payroll reserve. The company needs $20 million for payroll in 12 days and another $30 million that may be needed within 3 months. The available choices include an institutional government, money market fund, an institutional prime money market fund, a bank deposit, and direct treasury bills. The treasury team values same-day access, faces counterparty concentration limits, and wants a competitive yield. Start by segmenting the cash. The 12-day obligation deserves a different liquidity budget from the 3-month reserve. Then compare risk, deposit insurance and bank exposure, portfolio credit, floating NAV, possible liquidity fees, maturity, and settlement. Next, examine operations. Which cutoff times, wiring controls, account registrations, signers, and backup procedures matter. Finally, recommend a layered solution rather than forcing every dollar into one product. You might combine immediate access government fund assets with direct treasury bills or other vehicles for the longer segment, subject to the company's constraints. Pause the video and build your recommendation. Defend the trade-offs, not merely the product name. Payroll is a poor place to discover that Liquid had an asterisk. Pause the video and answer 4 questions. First, which statement about money market funds is correct? They are FDIC insured deposits. They are registered investment companies holding short-term instruments. Their yield is fixed by law, or they never lose value. Second, what does weighted average life emphasize? Only the next coupon reset, final legal maturity and extension risk, expense waivers, or shareholder age. Third, what are the general minimum daily and weekly liquid asset levels after the 2023 reforms? 10 and 20%, 25 and 50%, 50 and 75%, or no minimums? Fourth, why can a run occur? Because the NAV is always too high, because redeeming early may avoid liquidity costs that fall on remaining shareholders, because the fund owns only cash, or because all investors have identical needs. Pause now. The answers are registered investment company, final legal maturity and extension risk, 25 and 50%, and first mover advantage. The point is not the letter choice, it is the mechanism behind each answer. Carry 6 claims forward. First, cash-like behavior is engineered. Maturity, liquidity, credit, diversification, pricing, and controls create the experience. Second, category matters. Government prime, tax-exempt, retail, and institutional funds are not interchangeable. Third, weighted average maturity is not weighted average life. Rate reset sensitivity and final maturity risk require separate measures. Fourth, liquidity is central. Higher buffers and cost allocation tools respond to first mover and run dynamics. Fifth, stable NAV is not insurance. A constant transaction price does not eliminate portfolio or operational risk. Sixth, match the cash job, access, preservation, insurance, tax, and yield should be prioritized explicitly. The chapter's broader lesson is that a simple shareholder experience can rest on a complex operating architecture. A few extra basis points should never be mistaken for free dessert. Next, we follow portfolio decisions into trading venues, execution costs, best execution, settlement, and the controls that determine whether an investment idea survives contact with the market. This final page is the refresh register for Chapter 8. Posen and Hamaker remain the conceptual spine. The SEC's 2023 Money Market Fund Reforms and Rule 2, A7 provide the current regulatory framework. Investor.gov supplies the retail-facing explanation of money market funds. The Investment Company Institute provides weekly asset totals and the broader industry fact book. Federal Reserve materials explain the money market mutual fund liquidity facility, while the President's Working Group report records reform options after the 2020 stress. These sources serve different purposes, and students should distinguish rules, official statistics, historical reports, and investor education from commentary. Do not memorize the web addresses. Learn which institution answers which question and recheck time-sensitive data when the course is refreshed. Chapter 9 moves from portfolio design to implementation. We will examine how orders are built, routed, measured, settled, and controlled. A money fund may look calm at the shareholder level, but every underlying security still has to trade, settle, and reconcile.